there's some question as to what the Volcker Rule would have allowed them to do. In theory, they were hedging, and the Volcker Rule would allow them to hedge, maybe not to the degree they did. Ideally, you don't want FDIC-insured institutions speculating in very leveraged transactions, and it's very strange that it happened under Jamie Dimon's watch, because Jamie's been very, very strict about keeping an eye on risks. I think a lot's already been changed. I mean, banks were doing things 2 or 3 years ago they'll probably never do again, or not do in my lifetime. They were taking risks when they didn't even know they were taking risk in some respects, and I think that's the scary part.
While the bill was passed, the huge financial regulation bill was passed in July of 2010, the regulatory agencies actually have to pass a couple of hundred rules to implement that bill. Unfortunately, that process is open to agency influence, and they have been in literally thousands of meetings and have filed thousands of comment letters, have buried the agencies with paperwork. Well, without the rules in place, there's not much to stop the banks from doing their wild betting, and basically it's gambling with their money, and because they get the upside and the taxpayers get the downside. So there's really no incentive to stop until the rules get put in place. Financial regulation is all about trying to make sure that these big banks don't threaten the American taxpayer and the Treasury again. And that's why they're going to be banned from engaging in proprietary trading, where they make huge bets, and sometimes they win and they keep the money and the bonuses, but when they lose, like they did in '08, everybody in the United States gets the bill.